Good morning. Welcome to 3 Minutes on Markets and Money. I'm your host, Lance Roberts, talking a little bit about, well, the market rally following Friday's employment report. I mean, just an astonishing employment report on Friday. 20.5 million people on the unemployment rolls. Now, that number substantially higher in reality, closer to about 40 million when you include all of the people that are no longer counted as part of the labor force, people that have left the labor force for other reasons. The actual number is much higher. What we're going to see in the revisions next month is the actual unemployment rate probably going from 14.5% to nearly 20% as a lot of those numbers are factored in. Again, the employment report only caught the first part of April, so considering the economy was shut down through the entire month, those numbers are going to get worse before they do get better. Beyond that, the stock market, though, really didn't seem to care at this point because, well, it's all about the Fed. We continue to have this very sharp advance in the markets, but over the course of the last couple of weeks, we talked about in the newsletter that we've been really kind of working this consolidation channel here now for the last 3 weeks. Haven't really gone anywhere after this initial rally off the bottom, which is suggestive of two things. Currently, either the market is going to consolidate here and break out to the upside, which we will almost immediately test at that point, the 200-day moving average. A break above that level would actually bring in the potential for the markets to rally back to all-time highs. That's the bullish case. The bearish case here is that we move into the rest of the summer, that we do get a retest of these lows that we've set in during the consolidation level, or potentially a retest of these lows that happened back at the 1st of April. Both of those are very likely targets here in the process of a correction, particularly as we get into the weaker months of the year. One of the reasons that we think that we're going to get a correction as we move into the summer months is simply just from the fact that the market has really kind of moved too far too quickly. Given the deterioration in corporate profits, given the deterioration in the economy, those are likely going to start to be measured back into the financial markets now that we're leaving earnings season and are going to start focusing more on the economic data. But more importantly, we are about to get our seasonal sell signal here for the month of May, and this potentially sets up an idea that we do get some corrective action in the markets over the next couple of months. Our money flow indicator is still negative here, but again, this can remain kind of low and flat here for a while. So as we go through a correctional process, we can see money flows turn negative and the market begin to work through a corrective process here. Nothing major. We're not talking about potentially setting new lows here or potentially going to all new lows. That is certainly still a possibility, but very likely we are going to see at least a retracement back at some point this summer, which will give you a better opportunity to put money to work. So 2 points of context here. One, markets could break out to the upside. If they do, we'll add exposure to the portfolios. If we do continue this consolidation and begin to weaken and break the 50-day moving average, which is a possibility, we'll have a better opportunity to put money to work later this summer. So again, just look at this market as a potential here for risk at the moment, which outweighs the potential for reward. We went through that data in this weekend's newsletter. So again, take profits here, kind of rebalance risk, control your exposures, and we'll get a better opportunity where we have a better risk reward setup probably later on this summer. That's 3 Minutes on Markets and Money. I'm your host, Lance Roberts. We'll see you next time.